We are now going to look at performing a valuation using discounted cash flows. And first, we are going to start with Gordon's dividend growth model. Now, we have already looked at Gordon's dividend growth model in previous lectures, so a lot of this should be revision from what we have already covered. And if we want to calculate the present value or the market value of equity using this model, we take D1, or our future expected dividend, and we divide by the cost of equity less growth. Now, please note when we deduct growth in this calculation, that must be constant growth in perpetuity. So it can't be growth of 10% for the next 2 years, then 5% for 3 years, then 8% for 7 years. It needs to be consistent growth in perpetuity. Where can we use this model? Firstly, the company must be a going concern. Second, the company must pay dividends that are expected to grow at a constant rate that is sustainable into the future. Obviously, if we have a company that doesn't pay dividends, we won't have anything to include as D1 in our calculation, so then we can't use this model. And the growth rate must be lower than the discount rate. So your growth rate over here must be less than your cost of equity. And the reason for this is if the growth rate is more than the cost of equity, you are going to get a negative percentage over here, and then obviously the formula won't work. Now, we saw when we looked at earnings multiples, that was preferable if we were valuing a majority shareholding. On the other hand, where we are using dividends instead of earnings, this is preferred where we have a shareholder that is only entitled to dividends. In other words, a minority shareholder. However, we can use this valuation method in order to value a majority shareholding, but then we need to add a control premium. All right, so it's preferable to use the method if we are valuing a minority shareholding. However, if we do use the method to value a majority shareholding, we just need to add a control premium. Let's look at example 1. Java discount stores recently paid a dividend of 60 cents per share. So if they recently paid a dividend of 60 cents per share, that is D0, or the dividend now, and they have 100,000 shares in issue. The shareholders' required rate of return, or in other words, the cost of equity, is 18%, and the directors believe that dividends will grow by 8% indefinitely. So if they are growing by 8% indefinitely, that means we have constant growth in perpetuity. Also, you can see the growth rate of 8% is lower than the discount rate, so we can use this method in order to calculate the market value of equity. So if we want to calculate the present value, we need our future estimated dividend, or D1. So we take the dividend now and we need to increase that by 8% to get D1. And I'm performing the calculation in total so that I can get the total market value of the shares. I don't just want the value per share, so I'm multiplying that by the 100,000 shares that the company has in issue. We then divide by our cost of equity less growth in perpetuity, and that gives me a market value of 648,000 Rand. Now, two important things before we move on to the next example. You can only use this formula where you have constant growth in perpetuity. So this company's dividends are going to grow by 8% indefinitely, so we can then use this formula. If you don't have constant growth in perpetuity, you can't use this formula. In addition to that, when I put D1 or my future estimated dividend into this calculation, it gives me the present value today. So this always jumps back 1 year. If I put next year's dividend in the calculation, it gives me a value today. Now, I want you to remember this when we look at example 2 on the next page. So we still have Java discount stores recently paid a dividend of 60 cents per share. So if that's what they recently paid, that is D0. They still have 100,000 shares in issue. The shareholders' required rate of return, or the cost of equity, is 18%. The directors believe that dividends will grow by 12% for the next 2 years and then by 8% indefinitely. And you need to calculate the market value of the shares. Now remember, we can only use Gordon's dividend growth model where we have constant growth in perpetuity. So when I get to the point where I have 8% growth indefinitely, then I can use Gordon's dividend growth model. However, for the next 2 years, the dividend is going to grow by 12%. So where you've got inconsistent growth, you can't use Gordon's dividend growth model. And instead, we are going to have to look at these 2 years separately. So if you look at the calculation below, we look at these 2 years separately. Then after that, we do a perpetuity calculation when we have 8% growth indefinitely, because then we can use Gordon's dividend growth model. So what we do is we just calculate what the dividend will be in year 1 and in year 2. So if the dividend now is 60 cents, I need to grow that by 12% in order to get the dividend for year 1. And I'm going to multiply it by the 100,000 shares in issue so that I can get the total dividend. Then if I want the dividend for year 2, that is also going to grow by 12%. So I'm just going to take the dividend from year 1 and grow that by 12%. So in year 1 and 2, I've got inconsistent growth, so I look at those 2 years separately. However, from year 3 onwards, I now have consistent growth in perpetuity, so I can now use Gordon's dividend growth model. However, we've already accounted for the dividend in year 1 and the dividend in year 2. So I'm now working with my dividend in year 3. If I want the dividend for year 3, I'm going to take the dividend from year 2 and I'm going to grow that by 8%. We then divide by our cost of equity less growth. The cost of equity in this question is 18%, and my growth in perpetuity is 8%. And that gives me a value of 812,851. Now please note, when we used D1 in our calculation, it jumped back 1 year and it gave me the value today. So applying that same logic, if I use D3 in my calculation, that jumps back 1 year and it gives me the value in year 2. So you add this to your year 2 column. We can then total these columns, and please note you can now check. We've now taken everything into account. We've considered the dividend for year 1, we've also considered the dividend for year 2, and in addition to that, we've performed a perpetuity calculation which takes into account the dividend from year 3 onwards. So we are considering all of the dividends for this company. We are now going to use the cash flow function in our calculator in order to solve for the market value. Please remember your first cash flow must be 0 because that's the cash flow now, so 0. Your cash flow at the end of year 1 is 67,200 and at the end of year 2, 888,115. Input those cash flows into your calculator. Remember, always show your calculator steps. What do we use as our discount rate in order to calculate the net present value or the market value? We are going to use the same cost of equity that we used in our previous calculations. So please note that's your cost of equity. And if you solve for the net present value, you have then calculated the market value of the shares. Now please note, this gives me the value of a non-controlling interest. So if we are trying to value 20% of the shares in a company, we are then valuing a non-controlling or a minority interest, and that's ideal. So that's why I said to you on the previous page that this method is preferable if we are trying to value a minority shareholding. You then obviously won't add a control premium because you are not valuing a controlling interest, and you will also never deduct a minority discount because the value that we have calculated is already the value of a non-controlling interest. Okay. On the other hand, if you use this method in order to value a majority shareholding or a controlling interest, you are going to have to add a control premium because this value that we've calculated over here does not reflect control. It is the value of a non-controlling interest. So if we want to value a controlling interest, we need to add a control premium. Then lastly, please don't forget to multiply by the percentage shareholding that you are valuing. So if we are only valuing 20% of the shares in the company, we need to take this answer and multiply it by 20%. However, in this question, we were just asked to calculate the market value of the shares, so we are calculating the value of all of the shares. Now, in the last two examples, I gave you the cost of equity or the shareholders' required rate of return. It was given as 18%. However, please note this does not have to be given. If you refer back to our lecture notes where we covered the weighted average cost of capital, you will remember that we can calculate the cost of equity either using Gordon's dividend growth model or the capital asset pricing model. So as a recap, if we want to calculate the cost of equity using Gordon's dividend growth model, we are just restating the formula that I gave you on the previous page. And instead of solving for the present value, we are going to solve for the cost of equity. So your formula is then the future expected dividend divided by the present value plus growth. However, please note, you obviously can't use this model to calculate the cost of equity if we are also using it to calculate the present value, because then there are too many unknowns. We can't not know the present value and the cost of equity. If we want to calculate the cost of equity, we need to know the present value. If we want to calculate the present value, we need to know the cost of equity. So if both of those are unknown, then obviously we can't use that formula. However, instead of using Gordon's dividend growth model, we can also use the capital asset pricing model to calculate the cost of equity. And when I use this model, I take my risk-free rate, I add beta, and I multiply by the market premium. And remember, the market premium is just the market rate minus the risk-free rate. However, please note, If you are calculating the cost of equity using the capital asset pricing model, and you are then going to use that cost of equity to value the shares in a company, it's important that you understand that one of the limitations of using the capital asset pricing model is smaller entities can often obtain higher values. So in order to address this, we add a small stock premium to the cost of equity of smaller companies. So if a company has a market value of less than 250 million rand, so that is classified as a smaller company, we then add a small stock premium. And normally a small stock premium of 5% is added. Now guys, chances are you're not going to know the market value of the company. So from an exam technique perspective, if you are using the capital asset pricing model to calculate the cost of equity, and then after you've calculated the cost of equity, you are going to use that in order to calculate the market value of equity. After you've calculated the cost of equity using the capital asset pricing model, you add another 5% in order to accommodate this small stock premium. So like I said, chances are you are not going to know that the market value of the company is less than 250 million. So if in doubt, there's no negative marking, please just add the small stock premium of 5%. So whenever you have to use the capital asset pricing model to calculate the cost of equity, and then after that you use the cost of equity to value the company, please just add the small stock premium of 5%. There's no negative marking, so you won't be penalized. Then lastly, if we can't use Gordon's dividend growth model or the capital asset pricing model to calculate the cost of equity, you can always take the cost of equity of a similar listed company and then adjust for entity level differences. So in the same way that we adjusted our multiple of a similar listed company for entity level differences, we also adjust the cost of equity of a similar listed company for entity level differences. However, please note, a multiple is a number. On the other hand, the cost of equity is a percentage. So your adjustment is going to move in the opposite direction. Remember we said if a company is more risky, we are going to decrease the multiple, and if they are less risky, we increase the multiple. You are going to make the opposite adjustment to your cost of equity. If the company being valued is more risky, the cost of equity must be adjusted upwards. And if the company being valued is less risky, then the cost of equity should be adjusted downwards. So please note, because we are working with a percentage and not a number, your adjustments move in the opposite direction. So instead of decreasing, you are going to increase the cost of equity. Okay, so your adjustment just moves in the opposite direction. And then just to wrap this up, make sure you understand the logic of the adjustment. Remember, your cost of equity is the same as the shareholder's required rate of return. It just depends on whose perspective we're looking at it from. From the company's perspective, it's the cost of equity. From the shareholder's perspective, it's their required return. So if the company is more risky, your shareholders are going to want a higher return. So if it's more risky, we adjust the cost of equity upwards. On the other hand, if your company is less risky, the shareholders will accept a lower return on the investment, so we adjust the cost of equity downwards.